you are bullish.
I am a little bullish.
Tell us why.
Well, I mean, when the way the curve is set up, like you said, we're in a backwardation type structure. And we see that front month futures over the back end futures, especially like I think around $1 over on the front month versus the second month. You know, as a trader for 30 some years, and I would tell you that normally that's one of the first structures that we look at as overall market. Which way do I want to be? And it doesn't matter if it's a grain market, it doesn't matter if it's a livestock market, it doesn't matter if it's a metals market. When you've got a market structure like NYMEX crude is now, where you're seeing the front month over the back months, that's really longer term bullish. And one of the perceptions is, of course, is that there's more demand front end than there is back end. You know, if you look at storage right now, we see Cushing, Oklahoma around 30-40% below the 5-year average. You see overall crude oil storage somewhere around 6 to 7% below the 5-year average. So we've got supplies even a little tighter, yet demand is still elevated to some point. And so when we look at the back end, of course, the market's expecting OPEC to increase production, and that's part of the negativism that we're seeing in some of the back month futures. And normally what we always say as a trading side, when we used to be on the trading floor, is the public more times than not is usually wrong. And they have the back end of the curve, in my opinion, too cheap. If I look at the OPEC production, that's the biggest news that we've seen basically is, okay, we're going to increase, bring back the 2.5 million barrels. Well, if they do that, let's go back and look where we were last time they were at those levels. And if we do that, and I go back 2 years ago on the long-term charts, $75 a barrel. So, of course, we're seeing U.S. production is raised too, but demand is also elevated as well. If I look at jet fuel demand example, jet fuel demand is elevated. We're higher jet fuel demand in the North American, even actually Asia, for this time of year versus we were a year ago. And you would think that's impossible with the tariffs. But overall, I think the back end of the curve is basically too cheap. As a hedger, I would look to leave upside in the back end of the curve, as I would look out in 26, 27. Whether you use callers, I like that, or whether you use outright puts and look to sell the calls later. But I think the market is undervalued. I think demand is there. So I think there's some upside left in the market. And like I said, if you hold a gun to my head and make me trade it one way or the other, do I think there's more risk in $7 to $8 of upside versus $7 to $8 of downside? I think the real risk is really to the upside with the geopolitical unrest that we've got with Russia, geopolitical unrest we've got with Iran, basically. I would just say that there's more upside in this market.
Okay.